Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb. Now, this week, we welcome back to the show Rob Arnott. Rob is founder and chairman of the board of Research Affiliates, a research-intensive asset management firm. Now, Rob, I've asked you back on for a couple of reasons. First, because we always have really interesting chats, and I know that the listeners super enjoyed the show that we did last time. But also because the question that we get asked the most on the show, out and about, everywhere we go, is there an AI bubble? And if there is, spoiler alert, almost everybody thinks there is. What do I do? What do I do? Now, you wrote back in March, you wrote a great report about this, about, whether this is a bubble or not, comparing it to the Dotcom bubble, looking at it in a wider context, etc. That was quite a few months back. And that was at the point when it looked like things were cracking slightly, right? Mm-hmm. Since then, if it is a bubble, it's an even bigger bubble.
Yes, it is.
One thing that we do know is that whether there is a bubble in AI or not, there is definitely a bubble in people asking us questions about whether there is a bubble in AI, and in politicians and ex-central bankers and supranational organizations looking at you, the IMF, suggesting that there might be a disorderly correction, as we euphemistically like to call these things, at a later date. So all this is going on, which is why I thought you, Rob, are the perfect guest. So, Rob, welcome to Merryn Talks Money.
Thank you.
Onwards. So let's start then with that report that you wrote in March. And am I okay to put a link to that in the show notes so everyone can look at themselves later?
Yeah, of course. Absolutely. Please put the link.
Okay, so there will be a link to this report in the show notes so everyone can read it in full. But let's start with talking about that. You basically, what you're doing is you're comparing it to the Dotcom bubble, which really was a proper bubble, an obvious bubble from so long in advance. And back then we looked at that bubble, all of us, and said, well, that's a bubble, but we couldn't tell you when it was going to burst. So one of the things you do is you compare the AI bubble, which is going to call it a bubble for shorthand here, the AI bubble with that bubble. So let's talk first about what's similar, what is the same between these two situations?
You've got frothy valuations. You've got a spread in valuation between growth stocks and value stocks that's become, to borrow the British term, ginormous. And it's you've got a spread in valuation between large cap and small cap stocks that's at record extremes. Now, one of the things that people say now that they also said in the dot-com bubble is, this isn't a bubble. This is real. Back then they said the internet is going to change everything. It'll change how we buy and sell goods and services. It'll change how we get our news, how we do our research. It'll change how we interact and network with friends, with family, with clients. It's going to change everything. And these are the dominant players. And they're going to build our future. Most of that was true.
All of the first bit was true, right? All of the first bit.
Yes. Yeah. Now, where the narrative failed is that newcomers came in, competed, and the leading players weren't all leading players 10 years later. In fact, the 10 most valuable tech stocks in the world coming into the year 2000, 0 out of 10 beat the S&P over the next 15 years. You had to wait 18 years for one, Microsoft, to actually edge past the S&P. 18 years is a long time to wait. The other things that happened were the adoption of the internet happened slower than the advocates expected. The adoption of AI is happening slower than the advocates of this revolution suggest. So the narrative, AI will change everything. My goodness, it absolutely will. It's breathtaking. Anybody who's used ChatGPT-5, it's astonishing how intelligent it is. We wrote an article, Fundamental Growth, that's on the internet and is likely to appear at a journal early in the new year. And we gave it to ChatGPT 5.0 and said, tell us what's good and bad about this paper. Tell us where there's repetition that we can trim. Tell us whether there are references or citations that we missed. It gave a 2-page summary of the paper that was better than anything I or Cam Harvey or the other authors could possibly have written. Beautiful, wonderful synopsis. Then it gave us a rundown of ways to improve the paper. We took most of its suggestions. Then it gave us a list of 10 citations we missed. 4 of them, we looked at them and we thought, wow, why didn't we think of that? Yes, put it in. 4 of them were more borderline. We ignored them. 2 of them didn't exist. So it still hallucinates. It creates stuff out of thin air, which is something that you've got to be very careful about. But it's breathtaking. The leaders of the AI revolution are leaders today. Will they be disrupted? Disruptors get disrupted. Think of the most valuable tech stocks in the world in 2000, Microsoft. It went through a tough decade, and then it regained its footing and became the world leader that it is today. Cisco's chairman in March of 2000 said, I don't see why we can't grow 40% a year as far as the eye can see. 40% a year means you're going to be 6 times as large in 5 years. How big are they now? They're 6 times as large. It took 25 years, not 5.
Yeah.
It's 8%.
This is exactly the kind of thing that we hear from NVIDIA, which, by the way, as we're speaking, has been hitting new highs. Exactly the kind of thing we hear from them, that this growth can go on indefinitely.
If you can find power stations to power I read somewhere that something like 5% of the U.S. power supply is now used by AI, and they're wanting it to double every year for the next 3 years. Well, that would take it to 40%.
Yeah.
There's a wonderful paper by Aschenbrenner, one of the co-founders of OpenAI, called Situational Awareness, that talks about the future of AI. And it's wonderful because it's so insightful on how many ways it can change the world. It's off target in a couple of ways. He says we need to increase the power generation capability of the U.S. grid by 40% by 2027. Well, maybe we should, but it's not going to happen.
and even of course, if you manage to increase the power going into the grid, making the grid resilient enough to carry that huge increase in power would be verging on impossible in a time frame like that, right? So there are power constraints on AI. There are regulatory constraints on AI, maybe ethical constraints on AI. And then I guess it's also the case if we stick with this comparison to the dotcom bubble and possibly even to maybe even the smartphone boom or whatever you like to call it from 2007 onwards, around there. Chinese competition, which didn't exist in quite the same way in the same volume then. We've moved from the similarities to the differences too quickly. That isn't what I meant to do, but we've done it. So there's more competition, global competition, that suggests that maybe first mover advantage isn't quite what it might have been, and maybe there's a first mover disadvantage, or there certainly was in the dot-com bubble. Yeah.
Well, rounding out the top 5 back in 2000, you have Intel. Was that disrupted? Good Lord, yes. You've got Nokia. It still makes phones. It was 5th most valuable company on the planet back in 2000. You've got Lucent. Lucent doesn't exist anymore. I mean, it's a graveyard. And the other part that's just fascinating is March of 2000, when the bubble burst, roll the clock forward 2 years. The NASDAQ was down 50% on its way to an 80% drop. Russell 2000 value, remember, value was trading cheap. Small cap was trading cheap. Again, same thing today. Russell 2000 value was up 53% in those 2 years. The bull market of the 1990s for most stocks didn't end until March of 2002. And that was 2 years into the bursting of the bubble. The big cap indexes were dragged down, but the median stock was up for those next 2 years. The same thing could play out today. I'm not predicting that, but what I am saying is that decoupling of frothy large cap popular names from very successful mainstream businesses in valuation can mean revert. And I think likely will.
Well, you say can mean revert. Historically, always have mean reverted.
Correct.
Which doesn't mean that it happens this time and doesn't tell us when it might happen. But there has never previously been a point when this kind of disparity has not reverted to a historical mean of some kind, yeah?
Here's a fun factoid. Members of the S&P 500 or of the Russell 1000 are at valuation multiples that are 2.5 times as large as non-members. Now, people will say, yeah, that's because these are wonderful companies and these aren't. Pardon me, over the last 30 years, roll the clock back 30 years, they were at parity. They were about the same valuation multiples. So they blew out 150 percentage point gap opened up. These guys, the non-members, have had earnings and dividend growth 1% a year faster than the members.
Oh.
So they're better companies on average that are valued at 40% the valuation multiples of the index members. We have a short paper, Membership Has Its Privileges, that's in draft form that examines this difference and just points out the obvious, that if you're a member of the index, membership has its privileges. You are entitled, 1, to a higher valuation multiple because you're a member. 2, you're entitled to steady inflows of capital, propping the price up and holding it higher. And both of those facts are realities of today's market. Indexing has really swamped the markets and has compromised the price discovery mechanism of figuring out what companies are actually worth.
Yeah, the point being that because of the rise of passive investing, companies automatically get flows every time anyone buys an index. So the differentiation between the valuation of stocks becomes much less.
Mm-hmm. That's exactly right.
Okay, but here we are. And I think, we're already talking ourselves into agreeing that this is a bubble and that it shows all the characteristics of a bubble. And then we have the few things we haven't discussed, like the insane levels of concentration in the U.S. market.
Global market.
We've been and global markets. Yeah. So we've been at concentration levels like this before. Have we been quite this high? So I think we have been near these levels, but it's always a massive danger sign. Not even near.
Not even near.
No.
This is the highest concentration in global and particularly U.S. because it's U.S. concentration that leads to the global concentration. I mean, the U.S. is 2/3 of the world's stock market. It's 3/4 of the developed world stock market. So if the Magnificent Seven, 30% of the U.S. stock market, they're 20% of the world stock market. These 7 companies. And yes, they're magnificent. Yes, they have product that everybody wants. Yes, they have product that everyone needs. Yes, they're reshaping the future of the world. But this is a competitive landscape. Look at Intel. I mean, even the CHIPS Act couldn't save Intel. And a $50 billion infusion from the U.S. government couldn't help it defend itself against the rise of NVIDIA because NVIDIA disrupted them. And disruption is normal. Disruption happens regularly in a healthy capital economy. Creative destruction is a real thing. If you are behind the curve, you're going to lose business and lose market share and be pushed aside. And that's actually a good thing. It means that the better ideas get a chance to gain traction and grow. And these 7 companies are all disruptors and are all very powerful in their industry, but none of them is immune to competition. NVIDIA's already got a number of organizations lapping at their heels with new super chips that are in some ways better than NVIDIA's. NVIDIA got a head start, which was tremendous. The story behind that's also fun. Jensen Huang said, these super chips that we're building, let's save some real estate on them and just not fill it with circuitry, because the next round of circuitry is going to be better, and we won't have to redesign the whole chip. Who builds a chip with dead space in it? It was a stroke of genius. It allowed them to plunk in the new, better stuff faster, a year or two faster than they would have otherwise. And boy, what a stroke of genius. So these are brilliant companies. That was his disruption of the whole silicon industry.
I suppose one thing we should just say as an aside is that it's not the concentration in itself that is necessarily a problem. And the UK stock market is also very concentrated. A very large percentage of it is just our biggest stocks. But part of the problem with this concentration is the correlation. So they're all in the same industry, all in the same business. And if you look at the UK market, for example, while we have concentration, the big companies are generally in different businesses. So it's both things, the concentration and the correlation between them, right?
Yes.
And the business connections between them, of course.
Here's a couple of fun factoids. The market value of the Magnificent Seven was 20 trillion at the end of September. That's bigger than all stock markets in Europe combined. That's bigger than all of the Chinese stock market. Basically, the market's value for a company is supposed to be the market's best guess at future profit distributions back to the shareholders, discounted back to today, so the net present value of future profits. What the market is saying is that the future profits of these 7 companies will exceed all profits generated by all of Europe, bigger than all profits generated by all of China. Is that possible? Yes.
Yeah.
Is that likely? I don't think so. These companies compete against one another. NVIDIA's 50% profit margins are not going to continue more than 2 or 3 more years because competition is coming into play. If they're, roll the clock forward 10 years, if they are 40% of the super chip market instead of 90, if their profit margins are still a robust 30%, not 50%, if the pricing power means that revenues per chip are down by 2/3 over the next 10 years, and that's probably conservative. Plug those into a spreadsheet, and what you find is, okay, goodness, their 2035 profits are going to be no better than their 2025 profits, and yet they're priced as if they're going to see stupendous growth. Palantir is another fabulous example. How many companies get to be priced at triple-digit multiples of sales, not of profits? It peaked at 180 times sales. So with sales last year of 2 to 3 billion, they're worth about 400 billion. Now, how do you justify 400 billion market cap when your sales are 2 to 3 billion? The only way to do it is to have those sales grow to 20 billion, 40 billion, 100 billion, and profits to match, and do that fast enough. Is that possible? Yeah. Is it likely? I don't think so. So I see bubbles galore. I also see some very profitable, highly successful companies priced at premium multiples, but not nosebleed levels. And so I think there's a lot of stocks in this bubble that are not nonsensically priced. And
yeah,
that's a good thing. That's a healthy side of the market.
Okay, I get the slight feeling that you don't think it's quite ready to burst yet. We're not quite at, Cisco levels.
Well, some of them are at Cisco level. Cisco crested it in early 2000 at 180 times earnings, and Palantir is way past that.
But I just want to read that one sentence that you write in this report, which I think kind of sums up everything you're saying, which is just very simple. Fast developing sectors riding waves of innovation and optimism are inherently volatile, which is what you mean when you talk about the regular disruption of these things. And one of the extraordinary things about a bubble is that inside the stories that people tell themselves inside a bubble, the general narrative that develops, there is no volatility. There isn't competition. There isn't the disruptors remain the disruptors. They do not become the disrupted. That's how the story works.
Exactly.
And the thing that tends to break these bubbles is either, it's a change in the cost of capital, it's a change in the wider environment, or it's the realization that the narrative doesn't include the next wave of disruption.
Yeah. And people talk about the jobs lost. Every technological revolution since the Industrial Revolution has destroyed millions of jobs. The thing is that painful to those whose jobs or whose families' members' jobs get destroyed. Yes. Do people care about those job losses a generation later? No. The thing that is different is that the computers will be more intelligent than we are in the not too distant future. In some ways, they already are. My CEO, Chris Brightman, likes to play with AI every weekend for 3 to 5 hours, testing its capabilities. And he had a conversation with GPT-5 about how AI fits in the realm of human evolution. And it gave a discourse, short discourse that was so insightful, you'd think it was from a double PhD in anthropology and philosophy. And it closed with the observation, we don't know yet whether human intelligence and machine intelligence will merge, or whether human intelligence will at some stage be a fond and distant memory for AI. And then it closes with the sentence, the wonderful thing in this revolution is that we get to choose. And I thought, who the heck is we?
Yeah. Well, that's an interesting question, isn't it? Who is we in this context? I don't think it's me. It might be you, but I'm not feeling like it's me.
But anyway, existential threat. Yeah. Do I worry about that? I don't, because I try to worry about things I can have any influence over. This revolution is coming and it's big. But who's going to be the disruptor in the coming decade? Who will be the market leaders 10 years from now? Some of market leaders today will be the market leaders in 10 years. Some won't. They're all priced as if they will be the market leaders.
So I think where we are now is that we are agreeing that we are at the very least in bubble territory, that valuations are in bubble territory, that there is not enough understanding of the next round of disruption. One thing we haven't mentioned actually is the extent of the Capex and the extent to which AI Capex is crowding out everything else in the US. And when stuff gets very, very Capex heavy, of course, if you do get disrupted, you're in a whole lot of trouble, right?
Yeah.
I mean, a lot of the Dotcom bubble was very Capex light, and same with smartphones, platforms, etc. Capex light, but this is pretty Capex heavy.
I'm glad you mentioned that. One of the fascinating facts about growth stocks is that R&D is positively and reasonably strongly correlated with future growth for companies. I mean, it's not perfect. You can waste money on R&D just like you can waste money on anything else. Capex spending is negatively correlated with future growth. Really surprising.
Ooh. Don't tell the AI fans that.
Well, here's an example. In a healthy capitalist system, happy customers are the essential component of success. If you're going to succeed, you must have happy customers who value your product more highly than what you charge for it. NVIDIA has happy customers. They line up for the privilege of getting on a waiting list to buy massive quantities of super chips. NVIDIA's customers have yet to figure out how to monetize that Capex. They're having trouble figuring out how to earn money on AI. And so is that going to happen? Yes, it will. But is it happening fast enough to support the prices of these stocks? Probably not. And therein lies one of the key challenges.
Okay. So add that into the mix, and we could say, and when you wrote this back in March, you said maybe we're in 1997, maybe we're in the late 1990s, or maybe we're right on the edge of that nasty bit beginning of 2000. We can't be sure, but it sounds like you would put yourself closer to the late 90s at the moment.
No. I would say that we're more likely to be near the cusp than not. Now,
okay. So let's put ourselves at November 99. You want to do that?
Sure.
We're in November 99. If we were in November 99, what would we do? The first thing we do is we'd sell our Cisco because we've already made pushing 3,000% on that, right? Then what would we do?
The trick about bubbles is never short them, because they can go longer, last longer, and go further than you can imagine.
That's what a lot of spread bettors found out in the UK in 1999.
And so what you do is you underweight. You fade your exposure to bubbly stocks and do it gradually. So just like people average in to a bargain, you average out of froth and take some profits and do it gradually and take your time at it because you don't know when the turn's going to happen. The same thing works when it comes to bargains. We're in the only major business in the global macroeconomy where people hate bargains. I mean, imagine if Tiffany's posted a sign saying everything marked down 20% before Christmas, and Cartier across the street posted a banner sign saying, shiny, beautiful stuff for Christmas, only 20% more than last year. And people flood Cartier and shun Tiffany's. When it comes to retail, people don't behave that way. When it comes to investing, people absolutely behave that way. And so you have to be careful with bubbles. It doesn't mean you have to own them. It doesn't mean you have to fully weight them. So fundamental index, which we invented 20 years ago, simply reweights the growth stocks down to their economic footprint. It doesn't kick them out. So the Magnificent Seven is 34% of the S&P 500, but it's 18% of RAFI. It's big. It's very big, but it's not 34%. And so that's one tool in our toolkit, fundamental index.
Explain that a bit further,
Sure.
because you've been on before, and there'll be some listeners who understand completely about your fundamental indices, and there'll be others who simply don't. So tell us a little bit more about how that works.
We came up with a strategy 20 years ago called RAFI, Research Affiliates Fundamental Index. Instead of choosing companies based on their market value, the more expensive they are, the more likely they are to be in the index. We choose stocks based on their economic footprint. How big is their business? What are their sales as a percentage of all public companies? What are their profits as a percentage of all public companies? If it's a big enough business, it's included, and then it's weighted by the fundamental size of the business.
And what do we mean by fundamental size of the business?
Well, just as an example, what are the sales of NVIDIA as a percentage of all companies in the world? It's a fraction of a percent, but it's close to 5% of world stock market capitalization. And so it's this big a company, it's this big in market cap. The fundamental index says, thanks for that lovely gain, I'm going to weight you down here. It doesn't say I'm going to kick you out. And so fundamental index is one answer. So fundamental index has two interesting attributes. It downweights the growth stocks, it upweights the value stocks, it gives you a stark value tilt always. Value has been terrible for 15 years. So why would you want to do that? Because it also has a rebalancing alpha. If a stock soars and the fundamentals of the company don't validate that rise, RAFI will say, thanks for the nice gain, I'm going to trim you. The market's constantly changing its price on what a company's worth. You're contra-trading against those whenever they're not validated by fundamental changes in the scope of the business. And so that contra-trading is a source of incremental return. So the cool thing is that RAFI globally has beat global value indexes by over 2% a year since the launch of RAFI 20 years ago, and has beat value indexes in roughly 3 out of every 4 years. There's hardly anything out there with that kind of consistency. And if you're able to steadily beat value by 2.5% a year and win 3 years out of 4, then to the extent you want a toehold in value as a safety net for your portfolio, why would you do it any other way? So this represents one of the possible answers.
It's interesting, isn't it? Because when you talk about the divergence between value and growth, to the extent you can make this distinction, value and growth, and also the divergence in valuations between large and small caps, the tempting thing for most investors, or certainly investors with my inclination, is to go pure value, go pure small cap, etc.
Right.
But I think what you're explaining is that doesn't really work because you have to wait so long very often. You know, your wait can be years.
Yeah.
Certainly this time around, there've been little moments where you think, oh, look, it's back, value's back, active management is back, etc. And then suddenly often the video goes again and,
Exactly.
the value investors don't look so great again. So, the wait can be very, very long for a pure value investor.
Your wait can be very, very long for any style that's out of favor. Growth has been out of favor for long stretches of time. And we haven't seen that recently. And so folks with less gray hair than me will often say, yeah, but that was ancient history. Growth hasn't had any troubles in the last 15 years. Absolutely true. But history has a knack for repeating, if slowly and if imperfectly. And when you get to these vast spreads in valuation, 2.5 to 1 between members of the index and non-members, 8 to 1 between growth and value measured on price to book value, 12 to 1 for growth versus value measured on price to sales ratios. 12 to 1, that's extraordinary. And so when we look at today's markets, you see things very, very stretched. You see a narrative that explains why they deserve to be stretched. But narratives set prices. You don't make money by betting on a narrative. You make money by finding where the narrative might be missing something. And what it might be missing is competition.
Yeah. What about a pure equal weighted index? So, most passive investing takes place in market cap weighted indices, which is why you end up with such a bias towards the bigger equities. And so if you're investing passively at the moment, the reason you have such enormous exposure to the Magnificent Seven and to America is because you're doing this on a market weighted basis. But there's a good argument to be made for the regular automatic rebalancing that comes with a pure equal weighted index.
It's interesting. Equal weighting has been around for a long time, and it works for the very patient investor. It gives you a stark small cap tilt because the big cap stocks are being reweighted down, and it gives you a relatively deep value tilt. But its alpha engine is the same as RAFI's, same as fundamental index. If a stock soars, you're going to trim it. With RAFI, if the stock soars and the fundamentals don't, you're going to trim it. But if the fundamentals rise with the price, you're going to be perfectly happy and stay the course.
Yep.
RAFI has the advantage relative to equal weighting of, firstly, working a little better. It's about 100 basis points per annum better performance. Secondly, it still buys large businesses. And so large businesses are often large cap. So it doesn't have the stark small cap tilt that equal weighting does, and therefore it has huge capacity. Equal weighting, if it was run on globally on a $100 billion scale, would run into some serious problems of having to buy more of the smallest stock in the index than exists.
Okay, that seems like a reasonable argument against it.
Yeah.
Okay, so not equal weight, or equal weight, it's an answer, but maybe not the best answer. Going straightforward value, not necessarily the best answer. So fundamental index approach that you are using sounds very compelling. And the risks to it are?
The risks to it are very simple. It has a stark value tilt. When value is out of favor, it will struggle to keep up with the market, but it won't struggle to beat value. It beats value relentlessly. So to the extent you want value in your portfolio, like I said, why would you do it any other way? It's so compelling, it's so simple, and it's so powerful. That's its biggest disadvantage is the value tilt.
Yeah. Rob, what would make you change your mind about the idea that AI is in a bubble? What would make you go, Dad, you know what? That's worth 190 PE. Or NVIDIA, it's going to grow 30% forever. What would make you look up and go, actually, we all go on about bubble. The bubble story is very compelling as well, right? I mean, as compelling as the narratives around bubbles are, the fact that there is a bubble that you should avoid and it's all quite exciting and there'll be a crash and you can be the clever person who predicts the bubble, etc. We all want to be that person, right? It's the top. Look, they rang the bell. I'm right. Everyone wants to be involved in that bubble narrative too. What could make us wrong about that?
I love your mention of the ringing of a bell. People who buy bubble stocks need to think about one thing. What's my sell discipline? What would prompt me to sell? Will I hear a bell chime that says now's the time? If not, fading your exposure gradually over time has the benefit of not having to wait for the bell, and has the drawback of you will look and feel like an idiot until the turn happens. None of us likes to feel like an idiot. As for what would make me think, gosh, this isn't a bubble, it's that the fundamentals actually catch up to the price. And to some extent, that's been happening. NVIDIA's profits and sales soared and continue to surge strongly. But it is priced to reflect an expectation of, let's say, 20, 30% growth per annum for the next decade. And that's a stretch. That's a lot of growth for a long time. It's not impossible, but it is implausible in a marketplace where competitors are coming onto the scene with new super chips that in some ways are better than NVIDIA's. And so at a minimum, they're going to see that 50% profit margin come down and the 90% market share come down.
For those who aren't interested in index investing at all, who aren't interested in straightforward indices or fundamental indices, etc., where do you see value? I mean, small caps, obviously, you've said. We like to think there's a lot of value in the UK market, despite our appalling politics and miserable economy.
Well, I think UK is a value market.
You say that as though it's a bad thing.
I don't think it's a bad thing at all. I think UK stocks over the coming decade will soundly outperform US stocks. US stocks have to deliver growth well ahead of what we've seen historically and well ahead of the rest of the world. Now, that narrative is out there, the American exceptionalism story. Okay, is there American exceptionalism? We're not smarter than Europeans or East Asians. We do have less regulation than Europe, and punitive regulation that treats success as a bad thing impedes success and impedes growth. So yes, that element of exceptionalism, I think, is slightly true. We're over-regulated, but not to the extent that Europe is. But be that as it may, does it make sense for the U.S. to be 3/4 of the developed world stock market? I don't think so. Does it make sense for 7 companies to be 20% of world stock market capitalization? I don't think so. This does represent an unusually concentrated and frothy market. I think that European stocks broadly are cheap, relatively attractive. They're cheap for a reason. The narrative tells us exactly why they deserve to be cheap, and the narrative is partly true. Emerging markets, are they going to have better growth than U.S.? Yeah, they just imitating us and borrowing ideas from us will allow them to close the gap.
But no correlation between growth and stock markets. We know that, right?
Correct.
It's all about where we start. It's all about starting valuation.
And if your starting valuation is low, fundamental index in emerging markets has a PE ratio of 8. If you can buy half the world's economy at a PE ratio of 8, why would
Maybe you should
buy the U.S. at PE ratios in the 30s?
China?
China is now cheap. It is headed by a guy who is a Maoist to the core. And so as long as she is at the helm, if you succeed in China, you'll be punished for it. And if you succeed in China and question the wisdom of the CCP, you're going to be disappeared for it. China is relatively inexpensive today, and for the patient investor is probably a good buy. It probably won't really get out of its way until you get another Deng Xiaoping at the helm, somebody who believes that success is not evil.
Argentina?
I think Milei is marvelous. He's courageous. Anytime you're paying people on government salaries to do more or less nothing, you've got a formula for stasis. And there are lots of government employees everywhere in the world who are doing great work. But when you get a hyper-regulated economy, again, in Argentina, success was seen as evil. If you were successful, you had to have done something wrong, and you needed to be punished. That's a terrible attitude for promoting future success, for promoting prosperity. And
living standards all around.
Yeah, it is far too common. Argentina, Milei is changing the narrative. I think he's a remarkable man, a little self-absorbed, but hey, so are a lot of leaders.
Yeah, definitely going to be a little stock market volatility there. Rob, listen, I'm taking up too much of your time. I'm really sorry. I promised you 35 minutes and here we are. This is irresponsible interviewing. But listen, tell me, Bitcoin. You got any Bitcoin in your portfolio?
Yes.
Obviously, they're not, it's not something for the indices, but you got some?
I do.
You do?
In 2013, I was intrigued by Bitcoin. I didn't see why it would be worth anything. Discounted net present value is zero. But as a libertarian, I thought, kind of cool to cut the links with central bankers trying to control everything. And so I went out and I bought a Bitcoin, and I still own one Bitcoin. I've owned it since 2013. My cost basis is $225.
Amazing. And you haven't lost the passcode, have you? Not like some other people on this podcast.
And I have no intention of selling it.
You still have access to your Bitcoin.
I still have the code to get into my Bitcoin. And yes, I could still sell it.
Fantastic. I still have the phone that once had the code on it.
Anyway, there's supposedly something like 20-25% of all Bitcoin that is simply lost.
Yeah, on holiday with my Bitcoin.
Yeah.
Happy times.
Yeah.
Never to be seen again.
Can never be spent by anybody. It's just poof, evaporated.
Yeah, which is, of course, the one thing that I've always had trouble with Bitcoin. No customer services. No one to call.
Right.
How do I reset my password? Would you like to know the name of my childhood pet? Would you like to know where I went to school? I can tell you my mother's maiden name. Just give me my Bitcoin. But it doesn't work like that. I'm very naive about it. Anyway, listen, moving on from Bitcoin. Gold. You got any gold in your portfolio?
Yes. I have a little gold in a safe at home. And burglars who are watching, please don't go and break into my safe. Anyway, it's there for peace of mind, but it's not a lot. It's enough to sustain me for 3 months.
It's the ultimate insurance, right?
Yeah. And I don't know how good it would be in a financial crisis severe enough that dollar bills no longer worked and credit cards no longer worked. So I don't know that gold would work.
Amazing. Thank you. One last final question, because I'm guessing that your answer to this might be interesting. Rob, what are you reading right now?
This is funny, being on a British broadcast. I'm reading a history of the American Civil War. It's a 3-volume by a historian named Atkinson, who's a brilliant writer. And the first of the 3 is The British Are Coming.
No one would be frightened these days.
And so it's a fascinating book. It's a dive into the personalities and personal interests and the thinking processes of the people who led both sides of the Revolutionary War.
Okay, well, that is a great tip. And I'm sure everyone will rush out to buy them. So I'm not sure they will. I'm not sure we have that many listeners who want to go for a whole 3 volumes, but we'll see. We'll see. Rob, thank you very, very, very much for joining us today. Absolutely fascinating.
Thank you for reaching out. And this has been wonderful fun, as always.
As ever. Thank you. Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. Are you on Twitter, Rob?
I am, but I've never actually done it personally.
Do you know what your handle is, Rob? What's your Twitter name? You don't know. We'll look it up. Don't worry about that.
It's probably at Rob Arnott, but I don't know.
Bound to be something like that. Right. Okay. So, as I was saying, you can also follow me and John on Twitter or X. I'm Merryn SW and John is John_StepX. This episode was hosted by me, Merryn Somerset Webb, produced by Sam Asadi and Moses Andam, sound designed by Blake Maples and Aaron Caspers, and special thanks, of course, to Rob. Thank you.